July 15, 1815. Waterloo, Belgium. Cannons shake the mud, smoke covers the fields, and Europe hangs on a few hours of gunfire. Napoleon, once the terror of monarchs, is facing the British and Prussian armies in the battle that will decide who will write the next chapter of European history. 200 miles away, in London, there is no gunpowder, no cavalry charge, just whispers and numbers. Inside the London Stock Exchange, Nathan Meyer Rothschild occupies his usual corner. He is not a general, he has no army, but he holds a weapon more powerful than artillery: information. While diplomats wait for couriers on exhausted horses, Rothschild already has a private network that beats every government. Relay riders, coded letters, and even carrier pigeons ferry news from the continent to London in less than a day. Everyone else will wait 3 days for official dispatches. In an age before telegraphs, that gap is everything. It is time, and time is money. On the afternoon of July 19th, Rothschild's courier arrives. The message is short and world-changing. Wellington has won. Napoleon is finished. The French Empire is over. Britain has narrowly escaped catastrophe. Rothschild is now in possession of the single most valuable piece of information on Earth, and he has it alone. He does not stand up and shout the news. He does not congratulate the British government. Instead, he begins to sell British government bonds, aggressively. Quietly at first, then openly. Other traders watch the most well-informed man in Europe dumping British debt. They draw the obvious conclusion: Rothschild must know something. Panic spreads through the exchange. If Nathan is selling, Britain must have lost. Napoleon must be marching on London. Traders desperately sell their own holdings before prices collapse. And collapse they do. Within hours, the value of British bonds is in free fall. Then, as the floor descends into chaos, Rothschild's agents spread silently across the exchange, move in the other direction. They start buying. They scoop up every bond they can at fractions of yesterday's price. A few hours earlier, the British state was expensive. Now, it is on clearance. The next day, the official news reaches London. Wellington has defeated Napoleon at Waterloo. The victory is real, the danger is over, and the bonds that looked worthless yesterday are suddenly the safest assets in Europe. Their price explodes. In a single maneuver, Rothschild is estimated to have made the equivalent of several billions of dollars in today's money. Whether the exact number is 40 million, 30 million, or half of that is less important than the principle. This was not illegal. There were no insider trading laws, no financial regulators, no disclosure requirements. It was pure information arbitrage executed by the most sophisticated banking family in Europe. And it revealed a principle that would dominate the next 2 centuries. Whoever controls information and capital does not just profit from nations, they quietly control them. Not with occupying armies, but with debts that governments cannot escape. Over the next 210 years, 5 banking dynasties would build the architecture of the modern financial world. They would fund both sides of wars. They would help design central banks on 3 continents. They would give birth to institutions that shape global finance to this day. And they would accumulate a level of influence that, in many ways, outran kings and emperors. They did not accomplish this from the shadows of secret societies. Their power was exercised in boardrooms, not basements. It is documented in bond prospectuses, minutes of meetings, charters of banks, and treaties. The power was not invisible. It was formalized, legalized, and wrapped in systems so complex that people eventually stopped asking who built them. What you're about to see are the 5 stages through which banking dynasties built the modern financial system. Which families dominated each stage, how they used government debt as leverage over policy, which institutions they burst, and how those institutions together now sit on or oversee more than $100 trillion in assets, while remaining beyond the reach of any single democratic vote. Understanding this is not conspiracy theory. It is financial history, told from a perspective most textbooks ignore. Traditional economic history focuses on abstract forces, interest rates, supply and demand, policy decisions. This story focuses on the families who shaped those forces, the institutions they created, and the mechanisms they designed to ensure that their influence would outlive them by centuries. Before we walk through the 5 stages, you need to understand the business model that made banking dynasties possible. It is brutally simple. Finance both sides of conflict, appear neutral, and make sure that whoever wins ends up owing you money. In the 18th century, European monarchs were permanent borrowers. War was constant. Palaces, colonial ventures, roads, navies, all of it consumed capital faster than taxes could supply it. Unlike modern governments, kings could not simply float bonds to millions of small investors or print paper money on command. They needed a handful of bankers who could advance enormous sums quickly and discreetly. Most banks were provincial. A London bank financed British needs. A Paris house financed French projects. Borders were not just political lines, they were financial walls. Money rarely flowed easily across them, with one exception: a family from Frankfurt, the Rothschilds. Meyer Amschel Rothschild began as a coin dealer and money changer in the 1760s, operating from a modest house in the Jewish ghetto of Frankfurt. He had 5 sons, and he understood that empires are built on networks, not on branches. In the early 1800s, he dispatched each son to a different financial capital. Nathan to London, James to Paris, Solomon to Vienna, Karl to Naples. Amschel, the eldest, remained in Frankfurt as the anchor.
This was not just a family diaspora. It was an early version of a multinational bank. The brothers could move funds internally, using family letters and bills of exchange that bypassed national restrictions. They could shift gold from London to Vienna, credit from Paris to Naples, faster than most governments could react. Crucially, they were not tied to one flag. When Britain and France went to war, the Rothschilds lent to both sides. London issued bonds, Nathan underwrote them. Paris needed loans, James arranged them. Funeral marches might play in Paris or London, but interest payments would continue in Frankfurt. Whoever won would pay. For the Rothschilds, war was risk, but it was also recurring business. This model, fund every side, stay officially apolitical, and get repaid by the survivor, became the template for dynastic banking power. And it taught governments an uncomfortable lesson that echoed far beyond the 19th century. Wars are not won by the largest army, but by the side that can borrow the most, the longest, at the lowest rate. By 1815, after Waterloo, the Rothschilds had become the financial spine of Europe. They held more sovereign debt than any other private entity. They had the fastest information network, a crucial advantage in a world without telegraphs or telephones. And they had demonstrated that they could move capital between countries in ways no single domestic bank could match. Now that raw power had to be translated into something more durable: influence over the monetary systems themselves. Stage 1 of dynastic banking power: control government debt, and you control the government. This is the foundation stone. Everything else is built on top of it. After the Napoleonic Wars, Europe was broke. Decades of conflict had left France, Britain, Austria, Prussia, and Russia deep in the red. They all owed staggering sums to private bankers, especially the Rothschild family and a few rival houses. In London, Nathan Rothschild became the primary lender to the British government. When Britain needed money for reconstruction, colonial ventures, or to roll old debts into new ones, they turned to him. He underwrote government bonds, distributed them to investors, and collected fees on every step. Over time, this wasn't just about transactions, it was about control. By the 1820s, Rothschild influence over British bond markets was so dominant that he could effectively determine the terms under which the government borrowed. He helped set interest rates. He decided which investors got the most attractive allocations. And if ministers pursued a policy he believed threatened Britain's solvency or his own interests, he could simply refuse to cooperate. Without his backing, borrowing would become dramatically more expensive. On paper, he held no seat in Parliament, no ministerial portfolio. In practice, he held a kind of veto over British fiscal policy. A similar pattern unfolded elsewhere. In Paris, James de Rothschild became the financial backbone of the restored Bourbon monarchy and later regimes. In Vienna, Salomon von Rothschild bankrolled the Habsburg Empire. In Naples, Karl Rothschild financed the Kingdom of the Two Sicilies. By 1830, it is estimated that the family held or controlled roughly half of all tradable government bonds in Europe. Pause on that for a moment. Half the bonded debt of an entire continent effectively owed to one extended family. When textbooks talk about the bond market disciplining governments, in this era, that phrase often meant a few powerful houses in London, Paris, Vienna, and the family letters passing between them. But even that was only step one. Sovereign debt gave leverage. The real prize was the power to shape money itself. In the early 19th century, Europe operated under various forms of the gold standard. Coins and notes were ultimately backed by metal. Governments could not simply print more currency without regard to their gold reserves. This constrained war spending, social programs, everything, unless you had something that sat above ordinary banks, a central bank. A central bank can issue currency, manage reserves, serve as lender of last resort, and lubricate government borrowing even when gold is scarce. Britain had one as early as 1694, the Bank of England, born as a private company that lent to the crown. By the 1820s, the Rothschilds were among its major shareholders and creditors. Other countries were slower. They had treasuries that collected taxes and made payments, but nothing like a modern central bank. The Rothschilds and their peers quietly encouraged the creation of such institutions. Their logic was simple. A central bank that could create liquidity could always find the money to service debts. And the people holding those debts were, increasingly, the same bankers lobbying for the central bank. In Austria, Salomon Rothschild played a role in establishing the Austrian National Bank. In France, James had deep ties to the Bank of France. In Italian territories, the family worked with the Bank of Naples and other proto-central banks. These institutions were typically granted monopoly rights to issue currency. Many were formally private, with shares owned by bankers and aristocrats, and only loosely supervised by governments. By mid-century, the Rothschild influence stretched across Britain, France, Austria, Naples, and Prussia. They didn't rule these countries. They didn't need to. They sat at the controls of the machines that created money and set the price of government borrowing. But Europe, for all its wealth, was an old, crowded stage. The next act would take place on a different continent, in a young country with enormous resources and a chaotic, underdeveloped financial structure. Stage 2. Move into America and weld its rising power into the European financial system. Roughly 1830s to 1913.
In response, the Glass-Steagall Act of 1933 forced the separation of commercial and investment banking. J.P. Morgan & Co. split into J.P. Morgan, commercial, and Morgan Stanley, investment. But the same relationships, the same networks of influence persisted. Names on the door changed. The underlying power structures evolved rather than disappeared. As the world struggled out of the Great Depression, the next catastrophe arrived: World War II. Again, governments turned to debt. Again, central banks and private institutions stood ready. The U.S. government borrowed over $250 billion to fight the war. The Federal Reserve kept rates low and ensured the bonds were bought. Wall Street underwrote the deals. By 1945, the United States held roughly two-thirds of the world's official gold reserves. European economies lay in ruins. The British Empire was financially broken. This was the moment when the center of global finance moved decisively from London and Paris to New York and Washington. And it was at this moment that the blueprint for the post-war financial order was drafted. In July 1944, delegates from 44 nations gathered in Bretton Woods, New Hampshire. Officially, it was a conference of governments, represented by men like John Maynard Keynes for Britain and Harry Dexter White for the U.S. Unofficially, the interests of American banks and their European counterparts hovered over every discussion. The Bretton Woods Agreement created two pillars: the International Monetary Fund, IMF, and the World Bank. The IMF would provide short-term support to countries with balance of payments problems and oversee exchange rate stability. The World Bank would fund long-term reconstruction and development projects. Both institutions would be headquartered in Washington and largely controlled by their biggest shareholder, the United States. The dollar was anchored to gold at $35 an ounce. Other currencies were pegged to the dollar. In effect, the Federal Reserve became the de facto central bank of the world. If you controlled dollars, you controlled global liquidity. But there was a third institution, older and far less visible, that would become the discrete meeting room where central bankers coordinated: the Bank for International Settlements, or BIS. Founded in 1930 in Basel, Switzerland, the BIS initially handled German reparations. Very quickly, it evolved into a club for central banks. Built on Swiss soil but shielded by special legal immunities, the BIS operates outside normal national jurisdiction. Its property is inviolable. Its officials enjoy diplomatic privileges. Its meetings are closed. Only central banks can be shareholders. During World War II, the BIS continued operations even as some of its board members represented Axis powers and others the Allies. After the war, when some politicians called for its dissolution, central bankers quietly protected it. They understood its value: a neutral, discrete hub where central bank monetary policy could be coordinated beyond the noise of parliaments and the press. By the mid-20th century, the architecture was complete. The Federal Reserve, 1913, to govern U.S. money. The BIS, 1930, to coordinate central banks. The IMF and World Bank, 1944, to manage global flows and constrain nations through conditional lending. Through board seats, advisory roles, and revolving doors between government and finance, the descendants and successors of the Morgan, Rockefeller, Rothschild, Warburg, and affiliated houses maintained influence over this architecture. But one constraint remained: gold. As long as the dollar was tied to gold, the creation of new money was limited. That limit would not survive the 1970s. Stage 5. Sever the link to gold. Create a pure fiat system, and let money become an instrument of policy unconstrained by metal. By the late 1970s, the Bretton Woods system was cracking. The United States was paying for the Vietnam War and domestic social programs with deficits. Dollars flooded the world. Foreign central banks held more dollars than the U.S. had gold to back them. Leaders like Charles de Gaulle of France saw the danger and called America's bluff, demanding gold in exchange for their dollar holdings. Gold flowed out of Fort Knox.
Confidence in the system shook. On August 15, 1971, President Richard Nixon went on television and announced that the United States would temporarily suspend the convertibility of dollars into gold. Temporary became permanent. The link was broken. For the first time in modern history, the global reserve currency was backed not by metal, but by faith. Faith in the U.S. government and the Federal Reserve. Every major currency quickly followed. The world entered the era of pure fiat money. Without gold as a brake, central banks could expand the money supply almost without theoretical limit. The only real constraint was political. How much inflation would the public tolerate? Central banks learned to tame inflation with interest rates and careful messaging. They embraced a new role, not just lenders of last resort, but managers of the business cycle itself. From 1971 to the present, the U.S. money supply has exploded. Trillions of dollars have been created. Asset prices, stocks, bonds, real estate have soared. Each crisis has been met with more liquidity. In 2008, after the collapse of Lehman Brothers, the Federal Reserve unleashed quantitative easing, creating roughly $4.5 trillion over several years to stabilize markets. In 2020, facing a global pandemic, it did it again, at even larger scale. Who benefits from this design? Money enters the system through banks and capital markets. The first recipients are financial institutions and large asset holders. They buy stocks, bonds, and property with newly created money before prices fully adjust. By the time that money trickles down to wages or savings accounts, inflation has often eroded its value. Gains concentrate at the top. The dynastic families of the 19th century have diversified, merged, or stepped into the background, but their institutional creations persist. Rockefellers moved into investment management and philanthropy. The Morgan legacy evolved into J.P. Morgan Chase, today holding trillions in assets. The Rothschilds run global advisory and wealth management businesses. The Warburgs' name lives on through merged banks and foundations.
Yet the real empire is now institutional, not familial. The Federal Reserve steers the U.S. economy with a balance sheet measured in trillions. The BIS gathers 60-plus central banks in Basel to quietly align policy. The IMF and World Bank set conditions on loans to almost every developing nation, shaping tax systems, austerity measures, and privatizations. Global banks from J.P. Morgan Chase to Citigroup and Goldman Sachs sit at the intersection of these flows. You do not vote for the chair of the Federal Reserve. You do not elect the leadership of the BIS. You do not cast ballots on the terms of an IMF program in a country you might never visit. Yet the consequences of their decisions, interest rates, credit availability, currency devaluations, shape your mortgage, your job prospects, your retirement. Summarize the journey, and the architecture becomes clear. Stage 1, roughly 1800 to 1850, control European government debt. The Rothschilds and allied houses finance wars, accumulate sovereign bonds, and gain leverage over regimes across the continent. Stage 2, 1850 to 1913, integrate the rising United States into that system. European capital flows into American railroads and industry. J.P. Morgan emerges as the bridge between Old World money and New World growth. Stage 3, 1910 to 1914, design and establish the Federal Reserve. A secret meeting on Jekyll Island produces a central bank owned by private banks, yet draped in government language. Monetary power in America shifts to an institution shaped by Wall Street. Stage 4, 1914 to 1945, use world wars and depression to consolidate power and create global bodies. The BIS, IMF, and World Bank formalize coordination among central banks and give creditor nations leverage over debtor states. Stage 5, 1971 to the present, abandon the gold standard and move to pure fiat. Central banks gain unprecedented power to create money. Debt and asset prices explode. Wealth concentrates at the top, while the system grows too complex and interconnected for any single government to challenge. The five dynasties, Rothschild, Morgan, Rockefeller, Warburg, and their peers, did not seize power with armies. They built frameworks, bond markets, central banks, multilateral institutions. Through these, they turned money into a tool of quiet governance, and long after individual family members lost direct control, the frameworks kept running, guided by a new generation of technocrats and financiers who inherited their logic, if not their surnames. Today, the U.S. national debt stands in the tens of trillions. Every dollar of that is someone else's asset. Pension funds, mutual funds, foreign governments, and above all, banks and central banks hold that paper. The Federal Reserve buys and sells it by creating reserves from nothing. The government pays interest with tax revenue. The cycle continues. Debt is not just an accounting entry. It is a claim on future labor. When money is created as debt, every new dollar carries with it a promise that someone, someday, will work to pay it back, with interest. 2 centuries ago, families like the Rothschilds understood something basic but profound. If you control the creation of money and the flow of credit, you do not need to conquer nations. Nations come to you. They line up at your door in peacetime and at your feet in war. Weapons change, flags rise and fall. Compound interest keeps marching. If this journey has shown you how banking dynasties helped build the financial order we live under, then the logical next question is not just, how did we get here, but what happens when the system they designed hits its limits? Because global debt, sovereign, corporate, and household, has reached levels that cannot grow forever. Central banks cannot print infinite money without consequence. At some point, math collides with politics. Inflation, currency crises, or controlled defaults become inevitable tools. As that moment approaches, the same institutions that profited from 2 centuries of expansion are quietly preparing, buying hard assets, land, infrastructure, commodities, while the public holds claims denominated in paper promises. Understanding the history of how this system was built is the first step. Understanding how it might be unwound, restructured, or replaced is no longer just academic. It is the difference between being a spectator to the next great reset or a casualty of it.